If the minority and the very few are the wealthiest, why is it that we listen to the majority? There are so many myths, misinformation, and really missteps that people take in their finances. We hear all the time about invest for the long haul, the market's on sale, investing is almost synonymous with the stock market, or compound interest is a miracle and we have to wait for 30 years, and if you budget, you're gonna get there. All of this is misinformation that leads us astray. And unfortunately, with all that hard work and all that effort, we don't end up wealthier. The minority are not doing this. They're not becoming wealthy because of compound interest, or they followed the millionaire next door, because those type of philosophies that are about cutting back, we have to recognize no one shrinks their way to wealth. Wealth is not a reductionist game, it's a production game. Wealth is a byproduct of the value creation in the world, and investing is different than gambling, and investing is different than saving. Saving is setting money aside, investing is trying to grow our money. But before we go and spend a single dollar on some speculative investment, why not keep way more of what we make? Why not find out the elusive obvious? The elusive obvious are those subtle lies that lead us astray. See, obvious lies are so easy to avoid. If I told you I'm a Martian right now, we just laugh and move on. Nobody thinks anything of that, right? But on the other hand, if we hear something that sounds compelling, sounds convincing, there's a million and billions of dollars put in the marketing behind it, and we look around and everyone else is doing it. JFK talked about how a myth is so difficult because once you view the world through the eyes of the myth, you look for everything that validates the existing myth. Or Thucydides said, if 50 million people do a foolish thing, it's still a foolish thing. So only the minority are wealthy. I remember early on in my life, I thought wealth was a function of risk. I thought if I just put my money in the stock market, I was told when I was 19 years old, if I put $70 a month into this mutual fund-based investment, that after 40 years I'd be a multimillionaire. They projected it at 18%, which they're not even allowed to do more than 12%. And even 12% seems ridiculously high, because if you ask or read about Warren Buffett, he'll say most investors should expect more like 6 or 7% from the stock market. And that might even be high when we look at a myriad of factors. And you can view videos that I've done on that specific topic. But the reality is, the poor middle class take their advice from people differently, and from different people than the wealthy do. When we look at a lot of the middle class kind of moguls and the people that are teaching them, we see Susie Orman, we see Dave Ramsey, even my buddy David Bach has have a lot out there in the media that way. And so a lot of that's about how much can you save? How much can you set aside? How good are you at budgeting? How can you put money into a diversified portfolio? And a lot of that isn't actually getting people the results that they want. I love people paying off their loans and not overspending and living within their means, but if living within your means becomes only reducing things, we're missing two other forms that can solve the issue. How can you keep more of the money you make? 4 main I's to do that. First, don't overpay the IRS. If you're getting a refund, you just gave the government a tax-free loan. If you're a business owner, there's probably a 93% chance or higher, and I say probably, for sure it's 93% of you are overpaying the government, but it may even be higher if you don't know the proper deductions, you don't know how to do something called reclassify your income by the type of corporation you're set up and how you pay yourself, or if you don't have the right team. The second way that we can keep more of what we make is loans and interest. Could you restructure your loans to lower your payments? Can you renegotiate your interest rate so that you're paying less money? Or can you take and reallocate dollars from underperforming investments or assets to pay off higher interest rate loans? These are ways for you to get immediate return. The third I of the 4, so we have the IRS, we have interest. The third one would be investments. Are there hidden fees? Are there, structures that create too much commission? Are there non-performing fees that are creating drag and not necessarily benefiting you? Things like legal fees and admin fees, right? If we can find and detect those monies and dollars, put them back into your life, you'll end up with more wealth. And the fourth I is insurance. Nobody loves paying for insurance. Well, what if you're paying for insurance that's not even giving you very good coverage? It's inconsequential things. You have the wrong structure. You haven't transferred your risk properly. So you're giving the insurance company money, but you're not getting enough bang for your buck. Those 4 places are ways we can keep more of what we make, so you can live within your means, either by budgeting, which really sucks, or be more efficient, which is much better. Or what if you expanded your means? What if you increased the amount of money that you made? Because if you're an employee, you figure out how you contribute to the bottom line And as you do, get a percentage of that upside within the organization. That's being more intrapreneurial within an organization. Or if you're an entrepreneur, what if you put in money into your business with the right people, process, or technological procedures to grow and expand that business? That's called expanding your means. It's investing in yourself, in your abilities, in your skill sets, in the ways that you deliver value in the world. And just think of it this way. How can you reach more people so that you can make more money? Or how can you more deeply impact the people you reach so that that ends up being more cash in your pocket? All of the people that are saying that wealth is a function of how much money that you can put away and how much money you have, when people tell you it takes money to make money, they want your money. Or two, how much risk are you willing to take? Well, risk can actually increase your chance of loss more than your chance of return. Or it's all about waiting for 30 years, and then one day, someday, it's all going to be okay. Well, that's failing 9 out of 10 times. So there's a different formula and format that the wealthy use. What is that? First and foremost, they have plenty of cash on hand. The most successful companies, the most successful investors, they have cash on hand so that when there's market turmoil or when someone's in trouble, they can rescue them with that cash and make money on the buy. What do I mean by making money on the buy? They're buying an asset at a discount because someone's illiquid. Someone that focused too much on net worth, had too much spending, had too many loans, couldn't adjust to an economy that changes. You have major opportunity, and the next time we hear about massive losses in retirement plans, I want you to have different eyes and go, no, it's not massive losses. It's a massive transfer of wealth into other people's hands. Make sure you're on the right side of that transfer by being in the know and becoming a better investor. The next thing is we want to make sure you keep a lot more of what you make and then pay yourself first. Set up a separate account. I call it a wealth capture account. It could be a checking account or a money market. It just can't be a business account where you're normally spending out of your business, or a personal account where you're handling the everyday things. And then you want to start putting a percentage of your money away so you automatically and naturally capitalize and capture money off the top. When you do this, then you just live on whatever's left over and make sure you don't spend more than what's left over. Look, I put together an investing guide. It's wealthfactory.com/investing. And if you check this out, there's 7 keys to being a successful investor. So A, we teach you how to scrutinize the source. And B, what you should know about get-rich-quick schemes so you can detect them, and then you can determine it's something you should avoid putting money into. Because I get it, they always sound compelling. It's not like they come and say, you're probably going to lose money, but you should do it anyway. They make it sound so seductive, so sexy. We're like, I got to do that or I'm going to miss out. But then we end up missing out on memories as we worry about the money we just lost. We end up missing out on money as we have the most expensive way to learn, which is through the most hardcore, difficult experiences. So that's why I want to put this guide in your hands. Let's understand where you're getting the information from. Who stands to benefit? If you think about financial institutions, they have an agenda. They're rigging the game in their favor. They want you to give them money all the time. They want to hold on to that money as long as possible and give you back the least possible. So rather than being used by these institutions, utilize them and start to rig the game in your favor. The way that you do that is you capture wealth, you start to invest back into yourself, you find ways that you can grow that wealth, and then you get really deliberate and get so clear about what can you do to keep so much more of what you make. Look, I did a video with Robert Kiyosaki where we talked about this. And we cut a segment out that talks specifically about how you make sure you have the right types of advisors and who the wealthy are going to for advice versus everyone else, so that you can make sure that you get so dialed in here that you never lose money again, or if you do, you can learn a lesson and it's with less money at risk because you know how to protect the downside. You learn that a lot of people making money in the stock market are the people issuing the stock or selling the stock more than someone that's just investing in a mutual fund, and all the types of limitations behind that. You start to see what happens when you think like a business owner, you think like a bank, and you start investing for cash flow instead of accumulation. So hopefully this is really helping you out to understand the minority are the wealthiest, and they've reserved things like having a family office instead of a financial advisor. When you know that distinction, you have a major insight. They start looking at ways that they can save tax before they invest a single penny. And in the win then play methodology that I've been unveiling and that I'm teaching, we show you how to make money on the buy, how to be more efficient with those dollars, and profit from your ideas before you ever spend or invest a single penny.